So it's two things you have to do. A, pay yourself, and then B, you have to have a board of directors. So we set up for our clients. It's just documentation and a board meeting. From a minute standpoint, we do it for our clients, so it's hands off. But literally every single person who's a business owner, if you're not doing the Augusta Rule, you're missing out on in between $5,000. But that's just here in Jacksonville. If you guys are like in LA or in Las Vegas, where it's events like, boxing things or Super Bowls, where it's $2,000 a night for Airbnb, it could be $28,000, and that's a lot more money, right? Which means it ain't 5,000 IRS to give you, it's 10,000. So that's called the Augusta Rule. Every single person should do it if they're a business owner. If you are an S corp, one more thing, my apologies. You have to be taxed as an S corp. If you're taxed as an LLC by itself or as a sole proprietorship, you can't do it. You have to be taxed as an S corp. But like I said, if your business makes over $25,000 a year, then you can do that, and you should make that switch from an LLC to an S corp, and we can help with that. Now, for my non-business individuals, same thing, right? You can also, if you go somewhere, you can rent out your house as well, or do something and get paid by somebody, a business, or if you have a fellow business owner, they want to have a meeting at your house, you can do it in the 14 days throughout the year, and that money is tax free as well. So you could be a non-business owner and still take advantage of the Augusta Rule as well. You don't have to be a business owner. A business owner, you just get paid two ways. A non-business owner gets paid one way. But everybody and anybody should be taking advantage of the Augusta Rule because it's free money that the IRS is giving you. So yeah, so your kids can become beneficiaries or board members, because your kids can be board members as well via the Augusta Rule, and you protect your assets from personal liabilities. And that's Mr. Matt. Did I explain the Augusta Rule properly? I got some questions. Okay, cool. All right. So yeah. So do we have access to slides afterwards? Yes. I'm old school. Sean, you old school? Class of '92. We all old school, Sean. I'm trying to take notes. Yeah, cool. Yeah. So you'll definitely get those slides. We email the recording and the slides. You'll get that tomorrow. Wait. So people that can do that during the FIFA qualification. Look at you, Joseph. Actually, let's congratulate Joseph, because he had another one of his clients do a trust. So we're going to give hand claps to Joseph for that, because I saw that come through. Joseph, congratulations. I know one of your clients did a trust the other day. So congrats to the bag, Joseph. 4-for-1 mobile notary in Atlanta. So get to the bag, Joseph. But yeah, so Joseph had the question. So people can, during the fee qualifications in Atlanta next year, people can rent out their homes. Yes. Yes. So the person rents out their home. Now you're a business owner, Sean, but for your family members, if your family members are non-business owners, they can rent out their home, and the money that they get, they can charge whatever they want for 14 days. They don't pay taxes. You, as a business owner, you can say, hey, I'm renting out my home for, as a business, for mobile, to myself, Joseph Smith, and whatever the average Airbnb is, if it's $3,000 a night, you charge yourself $3,000. You do it over a 14-day time period, that's $36,000 a year. So you're just moving money from your business account to your personal account. So you think $36,000 a year at the, again, 40% tax bracket, that is 36 and 40, 18. That is $14,000 that the IRS is going to give you. That's not a deduction. That's money in your pocket. That's $14,000 the IRS is going to give you to do that. So yes, it is a huge opportunity. Stella had a question. Is the Augusta Rule new? So no, it's not new. The Augusta Rule we've been using it for clients for the last 4 years. So I'm a certified financial planner. So, of course, we invest clients' money. But about 4 years ago, that's when we actually started not only investing clients' money, but actually doing tax strategies and now filing their taxes. This is the first year we actually hired a CPA firm. So we don't only just do tax strategies, we actually file taxes for individuals. So if you need help doing that, we can definitely help. But no, it's not new. I know for Augusta, Georgia, the master's been going around for like 60 years. So it's definitely not new at all. And most people just don't know about it because nothing against a CPA. We have CPAs on this Zoom. Of course, we have clients of the CPAs. But a CPA, their job is not to do these types of tax reduction strategies. Their number one job is to file your taxes and to keep you compliant with the IRS, right? So yes, from a payment standpoint, they don't get extra money by doing these strategies. And, come tax time, they're as busy as they can be. So they're doing a great job filing your taxes. But like the other things, like the strategies, how to reduce LLC versus S Corp, those types of things, like that's not their job. So they might give you information, they might not, but their job is to file your taxes and keep you compliant. So a lot of people just don't know about. I mean, it's thousands of things. Like I would say, not all, but a majority of our clients, especially our business clients, they don't pay taxes. Like they always get a refund because there's so many things out there that you can do fair and reasonable and ordinary, put a pursuit of income for your business that you get to write off. So revocable education trust. Revocable education trust is where you use insurance or real estate to fund your trust. Again, we have irrevocable trust. You can do a inside of your revocable trust, you can put verbiage in there to make sure that money is funded for education. And if it's structured properly, when it's taken out, the trust pays taxes. However, if it's used towards educational expenses, like I talked about, it's tax free. Or you could do an irrevocable education subtrust. So again, we don't recommend irrevocable trust, but if you want to do it that way, you can. It's best to put this into a revocable trust. But for a irrevocable trust, it's IRS code 2503, where tuition payments made directly to a school. Tuition payments, not educational expenses like a car or laptop, but tuition payments made directly to a school are not subject to gift tax, which means it does not count towards income as a student. The reason why this is important because we have FAFSA, right? And FAFSA is, I think it's $7,600. I know it's 7,000 is something. You guys can correct me if you guys know how much it is, but I think it's $7,600. Where anything over that, then that could be affected with the aid that we get, right? So having it this way and the income that is received, then it doesn't count towards the student. But that's why, like I said, by doing if we didn't want to do do irrevocable and have that verbiage in there, since the money is going from the trust money can go to you, the parent, and the parent is just giving the money instead of it going directly to the child, right? That's why when I talked about earlier, in your child, that's one of the reasons why we don't recommend paying your child directly to their account because it's income that's going to them. So when your child is in school, you can still pay he or she or your grandchild. You can still pay them. You can still keep them on payroll even when they're in school. However, that income that they're getting is taxes. If it's funneled through properly, then we can make sure that there's no taxation there on them. It's less than $7,000 so that they get all of the financial aid that they can. All right. So the scenario, college rent to wealth strategy. So your child or grandchild is attending a college university. It's always best in this case to get the biggest bang for your buck is to do a duplex, like a single family house. Yeah, you get 2, 3, or 4 bedrooms. That's good. But I would say not a duplex, excuse me, like 3 or 4 bedrooms is the best because you get the biggest bang for your buck. Not a duplex, but like a 4 bedroom property. And one is for the child, and the other 3 rooms is rented to the students. And it also teaches them as well, like, your children might be all right, like my wife, when we was in college, I went to TSU, she went to MTSU, she was an RA. So as an RA, she got life lessons on how like to deal with people on her floor. So it's also kind of life lessons that he or she's able to learn, as well. And you really can't put a price on that. Like I said, first, you form an LLC to buy a property. It's LLC into the trust, or do an LLC by itself, but never just buy a house and never put an LLC. So you can buy the house first and then do the LLC, which is better from a credit standpoint. Buy that house and then put it to an LLC, but you want to make sure that house in the LLC to protect yourself. The LLC is owned by the Family's Revocable Trust. So again, it's in the trust. We control everything. We own nothing from a liability standpoint. But then the trust lists your child or your grandchild as a beneficiary, but they're not the owner. So they are the beneficiary, but they are not the owner. So if something happens to you, you pass away, then the trustee passes it to them, right? But still through the trust, so that there's no income there from a taxation standpoint. And if it's less than $23 million or $40 million, if you're married and you pass away at the same time, they don't pay taxes anyway. So it's really tax free. But this keeps the property out of your personal estate, liability, and it sets you up for a tax efficient transfer. So I'm going too fast. So step number 2, collect rent and offset the cost, right? So we rent out the extra rooms at $900 a month. Again, I have maybe not 30, but in between 20 to 30 clients that are doing this for their kids in college right now or have. So it's not like theory. We're doing it. And again, we're going to do this in about 6 months after Tamia's first year at Bethune-Cookman. But you rent out the extra rooms to students at $900 a month, to use example. So let's say it's $900 a month, $2,700 a month. That's $32,000 a year. But it's the kicker. And from a tax standpoint, this is how you really take advantage of it for your personal money. Because the other 2 months in the summertime, if they don't leave for the summer, you can't do it. But if they do leave for the summer, you want those 2 months to be an Airbnb. The reason why is because you're an active investor. And this is very, very key when you come to your taxes. Anybody that does real estate being passive and active. But let me answer these two questions. I'll get back to that. So just share. Okay, cool. So Franklin, I have some existing LLCs that I own personally. How do I change ownership to the trust? That's a great question. Great question, Franklin. You actually just put it into the trust. So when you have your trust, you have what you call your schedule of assets. And your schedule of assets basically lines who, if something happens, what happens to the LLC. So by putting that LLC in the trust as a schedule of assets, and then in the additions and restrictions part, saying what happens to that LLC if something happens, then that gets the LLC inside of the trust. Right, so you're gonna keep the LLC, but yeah, that's how. So in your schedule assets, the description of the LLC, what it does, name of the LLC, and then what happens in your restriction. And this is part of the trust when you create the documentation. Who gets it? Sell the LLC, not sell the LLC. The mix of like the ownership, like who gets, who owns it now, if it's you and another person, all that stuff you put into the restrictions, and this is part of the trust, and it is now inside your trust. So, so I hope that that helps answer that question, Franklin. Not, then just ping me again. It's okay. I'm sorry. So have what you call a wow, time flies. So you have what you call an active and passive. Very important for everybody. Anybody that does real estate, you want to think about this. So anybody that does real estate, if you're just renting out things long term, so you have like renters and you're renting throughout the year, right? Long term is a passive investor. You're all investors if you do real estate, but a long term rental person is a passive investor, right? Passive means the money that we make with our rental income, all the expenses we can only write off towards our rental income. So let's say I got a two job, I make $100,000. My rental income is 20,000. My expenses is 20,000. So I just get to write off $20,000 because my income is 20,000. But if I do an Airbnb, once I have Airbnb, from a tax standpoint, I am looked at as an active investor in real estate. I'm not doing anything different because Airbnb is more things, right? You might have a person managing your Airbnb, but since there's more things being done throughout the year for different renters throughout the year, you are now an active investor. Where in the tax code, if you're an active investor with real estate, that means all of your expenses, you get to write that off towards your rental income and your W-2 or business income. Meaning, same scenario. I'm a W-2 employee. I make $100,000 a year. I got rental income that's 20,000. But now I'm writing off everything with my Airbnb, and my expenses are 40,000. Well, guess what? Since I'm an active employee, I don't write off just $20,000, which is how much I make as a income for my Airbnb. I get to write off all 40,000 towards my $20,000 of Airbnb income and my $100,000 of W-2 income. That's 20,000 more dollars of write-offs. $20,000 of write-offs in the 40% tax bracket is $8,000 that the IRS is giving to you every single year. If you're in the 22% tax bracket, that's $2,500 every year that the IRS is giving you for doing an Airbnb. So you see people on YouTube and social media talk about why to do Airbnbs. That's the best reason why. Airbnbs are more headaches, right? But from a tax standpoint, the IRS gives you more money by doing an Airbnb compared to a long-term rental.